So I was reading about these proposed changes to equity derivatives trading from SEBI, and honestly, some of it feels like reading another language. What's all this about changing how they calculate open interest or OI to something called future equivalent?
Right. Well, the current way they calculate OI, which is just adding up all the outstanding positions, futures and options, in notional terms has some flaws. Basically, it doesn't really give you a true picture of the actual risk exposure, It's like imagine adding apples and oranges and calling it fruit. It's technically correct, but not very informative.
Okay, I get that it's not perfect, but why is this notional based OI so problematic that they need to change it?
Well, one big issue is that it can lead to stocks getting pushed into this ban period artificially without any real risk buildup. People can take these big positions and options that are way out of the money, which don't carry much delta risk, just to inflate the OI and trigger the ban. It's kind of like stacking the deck.
So it's like someone using a loophole to mess with the market. So, what does this future equivalent or delta based OI actually do?
Think of delta as a measure of how much an option's price will move for every $1 move in the underlying asset. So instead of just counting the face value of all the options, they're weighting them by their actual price sensitivity and summing them up to get a more accurate picture of exposure.
Okay, so it's a more precise measurement. So, how would this delta based calculation work?
Basically, for each stock or index, they'll add up the delta of all the open positions in futures and options. Long futures have a delta of +1 times the notional value. Options have deltas between 0 and +1 for long calls/short puts, and between 0 and -1 for short calls/long puts, and then they sum it all up.
Got it. So instead of just adding up the face value of everything, they're using this delta thing to figure out the real exposure. So what exactly is MWPL? They want to change that too, right?
MWPL stands for market-wide position limit. Currently, it is 20% of the stock's free float market capitalization. The shift to delta-based OI requires a recalibration of this limit. So you can think of it as the speed limit for how much people can bet on a stock using derivatives.
Okay, I see the connection now. So how are they planning to change the MWPL and why?
Right. So the new MWPL will be the lower of 15% of the free float market cap or 60 times the average daily delivery value in the cash market. The idea here is to link the MWPL to actual trading activity in the stock, which will reduce potential manipulation.
That makes sense. So tying it to cash market delivery volumes makes it harder to just inflate the OI artificially. So what happens if a stock actually hits the ban period?
Under the current rules, you can only close out existing positions. But the proposal is that even during the ban period, you can take new trades if they reduce your overall future equivalent OI. The idea is to let people reduce their risk even when a stock is under pressure.
Okay, that sounds reasonable. So you could buy put options or sell call options to reduce your delta exposure, even if the stock is in a ban. How will they actually make sure people follow this rule?
The broker's trading software will have a built-in check to make sure that any new trade during the ban period actually decreases the participants' net delta exposure in that stock. It's like having a breathalyzer for trading,
That's pretty clever. It sounds like they're trying to make the whole system a lot more responsive and less prone to manipulation. Speaking of real time, I read something about intraday monitoring of MWPL. What's that about?
Currently, they only check for MWPL breaches at the end of the day. But because footneck OI can change so quickly, especially on volatile days, that might not be enough to catch real-time risks.
So, what's the solution? More checkups during the day?
Exactly. Clearing corporations will now monitor MWPL utilization at least 4 random times during the trading session, and they'll share those snapshots with everyone in near real time. This way, participants can make timely risk management decisions,
So, it's like having traffic updates for the derivatives market. Warning, congestion ahead, reduce your positions. What about mutual funds and EIFs? How are these changes going to affect them?
Well, currently, the way they measure exposure for futures and options is different. Futures are measured in notional terms, but long options exposure is only measured by the premium paid. which doesn't really account for the leverage in long options.
Right. So it's like saying you're only exposed to the cost of the lottery ticket, not the potential winnings or losses. So, how are they going to fix that?
They're going to measure both long and short options on a few TX basis, which captures their real price sensitivity. And they'll allow netting at a stock or index level so they can offset long and short positions. All of this is to just get a better handle on the true risk in their portfolios.
Okay, that makes sense. So, it sounds like it's a more accurate way to measure risk. You know what's not fun? Exceeding your investment limits and getting penalized. Disclaimer: we advise investors to check with certified experts before taking any investment decisions.
Yeah, definitely. They are revising position limits for index futures and options. Specifically, they are revising index options limits for end of day and intraday.
Right. So, what kind of numbers are we talking about here?
For index options, the end of day net future Q limit is set at INR 500 crore with a gross future Q limit of INR 1500 crore. Intraday limits are higher at INR 1000 crore net and INR 2500 crore gross. For index futures, the end of day limit is increasing from INR 500 crore to INR 1500 crore with an intraday limit of INR 2500 crore.
Okay. So, those are pretty significant changes. And these limits apply to everyone, right?
Exactly. FPIs, MFs, trading members, clients, everyone's subject to these limits. Of course, positions backed by actual securities or cash like instruments are exempt, as before. Now let's shift gears to other measures designed to enhance trading convenience and risk monitoring.
Sure thing.
SEBI is also proposing to introduce pre-open and post-closing sessions for the derivatives market, mirroring what already exists in the cash market.
Interesting. Why?
Well, it could improve alignment between the cash and derivatives segments and potentially lead to smoother transitions at market open and close, with less of those crazy volatility spikes.
Okay. That sounds like it could be helpful, especially at the open when things can get a little wild. Will this apply to all derivatives?
Initially, it will only apply to current month futures contracts on single stocks and indices. And in the last 5 trading days before expiry, they'll extend it to next month futures contracts as well.
All right, that seems like a reasonable starting point. So, what else is on the table?
They're also talking about eligibility criteria for derivatives on non-benchmark indices. Basically, they want to make sure these indices are diversified enough to prevent manipulation.
So, what kind of criteria are they considering?
The index needs to have at least 14 constituents. The top stock can't weigh more than 20%. And the top 3 together can't exceed 45%. Plus, all the other stocks have to have a descending weight structure,
Okay, so they're trying to prevent a few big stocks from dominating the index and making it easier to manipulate. One thing I am curious about is individual entity level position limits for single stocks.
Right. So the proposal is to set these limits as the lower of a percentage of MWPL and a percentage of the total Footneck OI across all exchanges.
So, why is it important to have these limits in the first place?
Well, for certain stocks with high MWPL but relatively low OI, a single entity could end up holding a huge chunk of the open positions, which raises the risk of exposure concentration.
Okay, I get it. It's like one person controlling too much of the pie. How will these limits be measured?
For now, they'll be measured in notional terms, like they are currently, but they might move to a delta-based computation in the future, in line with what they're doing for indices.
Okay, that makes sense. So it seems like these changes are pretty comprehensive. So what happens next?
Well, SEBI is inviting public comments on all of these proposals. Anyone, individual investors, market participants, anyone can submit their thoughts and suggestions.
Awesome. So it's not a done deal yet. And where can people submit their feedback?
They can do so via an online platform on the SEBI website, and the deadline is March 17th, 2025.
Wow, that's a lot to digest. So basically, these proposed changes are aimed at making the derivatives market safer, more efficient, and less prone to manipulation, right?
Exactly. It's all about getting a more accurate picture of risk, preventing artificial market distortions, and ensuring that everyone plays by the rules. This is a way to balance trading convenience and risk monitoring.
Definitely appreciate you breaking this down. Now, if you found this conversation helpful, don't forget to like, share, and subscribe to our channel for more insights. But what do you think the long term impact of these changes will be.